There we go. Hey, everybody. We're live. Welcome. Hey, Sam, how are you today?
I'm doing great. I've been, haven't got to spend much time outside, but I opened the door for a few minutes and felt a nice breeze. And my azaleas in my backyard are going crazy right now. They went from, the potential for blooms to just
We have,
erupting with color.
and just in case, folks, if you you have joined us, you have stumbled into the weekly happy half hour program with Carolina Retirement Planners. I'm David Shakavage, and this lovely lady is my daughter, Sam Shakavage, Samantha Sam for short. And for 46 or 47 weeks, how many weeks have we been doing this, Amy?
40, the big 40.
40 weeks, or yeah, 40. So for 40 weeks, we have been coming to you at 4:30 every Thursday. The idea was, hey, grab your favorite drink, join us, and we're going to have some fun. And so welcome if you're new here. If you're here,
remember, no share party, no more. There's no more of that, but they could share on their page.
You can share on your page. If you're here, type into the chat, say hi, because we can't see you, and we won't know you're there unless you type into the chat and say hi. I'm
Feel
here.
free to lurk. We welcome lurkers, but if you would like to say hi, we also would love to hear from you.
Yeah. So we've got some regulars are here every week. What are you drinking today, Sam?
Lately I've been doing more, sparkling waters and teas, but today just felt like a boozy day. So I rummaged around the fridge and found a hard cider.
Well,
it seems nice and refreshing for this beautiful spring weather.
I am drinking my normal herbal tea. Doesn't look like it, but trust me, this is herbal tea. However, there is a Manhattan in my near future. So I plan to have a Manhattan up, probably a High West double rye Manhattan up here shortly. So.
Oh, that'll be nice.
So, and Amy, what are you drinking today?
Well, I'm going light. I'm drinking a Mick Ultra infused with lime and prickly pear and cactus.
Okay, this is a Texas light beer. What can you say? Amy, by the way, is the lady behind the scenes. She's our director of client fun, and she is the one who makes this all work. I do it in Zoom and link it to Facebook, and you can see all the reruns both on our Facebook page by clicking on videos, or you can go to our YouTube page and see them all on our YouTube page. Or go to our website and click under events, and they're all listed, all 39 of them up till now. So we have some people that have joined us. Who's joined us, Sam?
Well, we have Teresa, actually, who's Amy's mom, who's tuned in. So, hey, Amy's mom, thanks for joining us. And Bill, thanks for joining us, Bill.
Jacqueline and Cindy are here.
Hey, Cindy. And Kay, probably with Ken as well. And
I think they sent us a picture today too, Kay.
Oh, did they? One of the Zoom pictures?
Yeah, I think
they
so.
did. They sent him a call. They really did. Yeah.
Cool. That's one of the days. It's National Zoo Day today, which we can talk about.
And we have Bruce and Robert.
And it's Bob and Val. Yeah, hey y'all. And Ellen watching from all the way down in Oak Island, where I'm sure it's beautiful and breezy right now.
Yeah.
And Kathy.
Stephen
and Nadine. And Carol Ann and JP. Hey y'all. Oh, we just got your entry, JP. We got it in right at the last minute. We got y'all in to the wine draw.
In case you're not aware of, if you kind of email us and ask us a question, tell us you're sharing it with someone, or just say, hey, I'm going to be there, we put your name in a drawing for 2 bottles of wine at the end of the half hour. That's kind of everybody's favorite part, you know? So we've got a whole group of people, a whole group of things to do there. Um, and
Wait,
what,
did you guys see? Pat has joined us, and he sent us a picture of a lion today.
okay.
Crazy.
Oh yeah, and because if I remember correctly, Pat and Reba, it wasn't at the zoo. They went to South Africa and saw them wild. Am I correct in that?
You're absolutely correct. Yes.
I think that's what, and they brought Flat David on the safari, if I'm not
Ah.
mistaken. So
They did. Yes. Yes, they did.
Flat David in South Africa. So thank you to Pat and Reba.
And let's see, we've got Kathy and Donna.
Donna, hi Donna, thank you for joining us. And Holly, hi Holly, and maybe Bruce.
Yeah.
Oh, nope, Ken's at work. So Kay, thank you for signing on by your lonesome right now. And Lori, hi Lori.
Lanny, a very regular, is here. She's here every week. And Lori's here. So what's our topic today? Anybody remember?
Oh, I don't know. I've been drinking so much of this cider. I'm teasing. So today we are doing part 2. Last week we were talking about why a retiree may want life insurance. And I saw you up there at the board. You were just scribbling as fast as you could. You were trying to fit everything into the short time that we had, and we decided to cool it and allow ourselves a second week to delve deeper into the topic. So
part
week
2
of life insurance.
So we're going to go talk about a couple other things about life insurance, and I think I'll switch to the other camera here. Oops, wrong place. I don't want to switch mics. I just want to switch cameras. And there we go. And in fact, I want to talk about one thing before that. Do you all remember this? Okay. I'm betting that most of the folks that are watching this now used to have something that looked like this. This was the old phone that sat on your wall. You actually had to dial it. Remember? I mean,
I dimly do. I think that you may have had one, but I don't think it worked. I think it was like a novelty at the point.
Yeah. It's like I don't know how old you have to be now to remember a dial. And you remember, this is the one like on the wall of your kitchen, and you had a 20-foot cord, and you were young, and you're talking to your boyfriend or girlfriend, and you would take that cord and string it all the way into the living room or something, hide under the table, and talk for hours to that girlfriend or boyfriend. You're in your early teens or late teens or whatever, and at that time a phone didn't do much else, but it made phone calls. I mean,
Do you remember misdialing?
You got a click for call waiting.
Yeah, if you ever misdialed on that phone, forget about it.
Oh yeah, there was. Now today we have these, right? We got one of these. Now with this, I know that I can. I wake up, I check the temperature outside. I check if I'm walking the dog, I can tell if I should walk them now or wait till the rain stops. Is the rain going to stop? Because I got this little map that shows me all that. I can, I get the latest Wall Street Journal reports on here. I can read the newspaper. I can keep up with all my friends. I can tune my Hammer Dulcimer with the built-in tuner. Man, I can take movies with it. In a pinch, I can even make phone calls, The difference is astounding. And this is much as what has happened to life insurance. It used to be life insurance looked like this, and now they've done a bunch of things to make it look more like this. Well, we're going to cover one or two of those things today, particularly how they can affect people that are in retirement. What does it make sense for? So let's talk about some of those things. And I want to start with a fairly new product that, again, serves many functions. It can help you accumulate money It can help you, it can actually work as sort of a CD substitute. Um, it can give you a death benefit. It can give you a long-term care benefit. And so it's really pretty cool. And I want to explain sort of how it works. This is a case, oops. Got my numbers written down here so I know the approximate amounts. You know, normally when you buy life insurance, you pay a little bit every year, you know, and then you get a whole bunch of life insurance. One way to do it is to pay a whole bunch at once. They call it a single premium, and that has certain advantages. So let's say, and these are approximate numbers, actual kind of numbers. Let's say you're 60 years old. Let's say you're a woman. So I'll just use an example for a woman. Man will get a little bit less because they don't live as long. Let's say you're 60 years old and you give the company $100,000. Well, let me even back off even more. I know a lot of people, they've got money in CDs or money markets. I call it just in case money. You might have $100,000 sitting there. You really don't think you're going to need it. You don't have any plans for it, but you just want it there in case. And you don't want to take the risk of putting it in the market. So you put it in a money market or a CD. Sam, what do money markets and CDs pay these days?
Oh, I mean, it's less than 1%, I think, right now.
Yeah, I mean, you almost need a magnifying glass to
But
look
the
at.
money market is, yeah.
It's earning nothing.
Hey, can I chime in really quickly? It's really, really hard. We're getting people saying, we can't see what you're writing on that board.
Yeah,
David.
Sam needs to.
No, David, your marker, we can't see.
Sam, you need to hide yourself, don't you?
Okay, I'll hide myself.
Okay, is that better?
Let me see. I think it's your marker is wearing low,
Okay.
maybe.
Let me try a different marker. So,
Yeah, there's
you've got-
something about the light. It's kind of like when you move, it wants to focus on you, and so it stops focusing on the green.
okay.
There we go. That's nice.
So let's say you have $100,000 in a CD somewhere or a money market. You're just in case money. Let's say you are a 60-year-old woman, kind of average health, and you go and you instead give this money to an insurance company in a single premium policy like this. Immediately, you would get $260,000 or so. And you can use that $260,000 two ways. One, you can die, in which case all the 260 goes to your spouse or your kids tax-free, just like a regular life policy. Or maybe you need long-term care. In fact, you don't even need to go into a nursing home. Let's just say you become disabled and you can't do 2 of the 6 activities of daily living and you want to be cared for at home. The company will give you, for the next 4 years, they'll give you 25% of it each year. So you can use that whole amount basically for long-term care. And in most cases, that long-term care benefit is tax advantaged. Now, let's go down the line. Let's go down the line let's just say 3 or 4 years. This 100,000 is actually going to grow. And I won't try to get into all the aspects. Basically, you can never lose money, but we don't know exactly how much you'll make, but it's probably on the order of the 3 to 5% a year. So let's say it's grown to $115,000. 3 or 4 years later, it's grown to $115,000. So you've got 15,000 here in gains. Well, if you want to, you can either take out the 15, that might affect some of this, but, or you can cash the whole thing and all of a sudden you need the money, you cash it in, you get all 115. Now, if this was in a CD that did pay, say, 5%, and the CD grew every year, you'd have to pay tax on that growth, even if you didn't use it. Because it's in this policy, you don't have to pay tax on it till you take it out, and then you'll pay tax. So you can defer the tax till you actually take it out. And so it's kind of nice because I kind of have my cake and eat it too. I can earn, probably more than I'm going to earn in my CD or money market. But gosh, in the meantime, I get all these extra benefits and it's very safe. So this is a single premium policy. And the newer ones, you don't even have to go through all the trouble of the blood test and everything else. They'll call you on the phone. They'll ask you a bunch of questions. They'll pull up your medical records online, and they'll make a decision in a day or two if you can get this or not. So it's even easier to qualify. And because you're giving them 100 up front, it's usually a little easier to get insurance than if you were buying a conventional policy where you only paid a little bit. So, boy, this is a powerful way for you to, powerful tool for if you've got lazy money, just in case money that you're saying, I don't want to put it in the market, but I want to be sure I can get it if I can. This might be a better place to park it. You're going to come out ahead. So that's one.
So Janie has a question. She said that she bought a single payment life insurance policy in 85 and it was assured it would never expire. But finds that now she's having to pay monthly towards it, or it will expire. How can one avoid that?
Well, I don't know what they told. When you get a policy, they got a column that says guaranteed, and the guaranteed column tells you whether it will ever run out or not. It's like absolute truth. It could be whoever sold you the policy maybe misled you or misunderstood it and said, oh no, it's going to be fine. These policies, because these policies are the ones we typically use are guaranteed. It will not run out if you give them 100,000 and you won't have to put in more. She got something else. That sounds a little funny. So that's one piece. What else do we talk? What else do we have on our list for policies to talk about, Sam?
You wanted to talk about income and charity.
Okay, let's talk about income. Now, this is again a little advanced, but it's a real cool application for a policy. We don't talk about it much because it takes 10 to 15 years to work. And if you're 65, it may be a little late, but if you're 50, 55, with people in their 50s, we often use this for. But think about a policy. When you buy a policy, you're going to get a death benefit. This is what they pay if you die. And most people, they want to put in as little money as they can to get this death benefit. When you buy, and that money that's in there is the cash. Sometimes they call it the cash value. Okay? And so when you're, say, working and you're trying to insure yourself, so if you die, your spouse and kids get money, you want to put in as little cash as possible for as much death benefit as possible. When you buy term, it has no cash and you get all death benefit, but it doesn't go on forever because they don't really sell you term when they think you're going to die. So about the time you get into your 70s, term sort of ends. But a cash value policy, most people try to maximize the death benefit. But what happens if you do it different? Oh, and by the way, they're charging you for this empty space. Every year, the cost that you pay the insurance company is equal to the amount they got to cough up if you die. So let's say we did it differently. Let's say instead of paying as little as I can to get as much death benefit as I can, let's say I went instead and I tried to buy as little death benefit as I could for as much money as I could. So now I've got lots of cash in here, but I have very little death benefit. Well, you might say, well, why do I want to do that? Here's kind of the reason why. Remember, this cash is growing, right? And these new policies, we can get some, because of the fancy structured product indexing they're doing, they can get some pretty good returns on that. And because I'm buying as little death benefit as possible, most of my growth stays in the policy and my cash grows. And so I have a place where I can grow the money. Now, what about taxes on that? Well, as the money grows, just like here, I don't pay tax as it grows. But when I go to take it out, one of the things I can do is I can take it out as a loan. I can borrow the money out. Now, Sam, do people get taxed on loans?
Not on life insurance.
No, I mean, or on anything really. I mean, if you borrow money for your house, you don't get taxed on the money they give you. If you get a car loan, loans aren't taxable. So you borrow the money out of the policy as a loan, and so you don't pay tax. And the companies arrange it so that they're still paying you interest on the loan, but they're giving you interest on the loan each year, even though you're paying interest, and it's called a wash loan. Basically, you don't have to pay anything on that loan every year. And over time, each year, you can start to take a little bit of that money out for retirement. But remember, it's not taxable. So, wow, I'm getting this money out tax-free, if you will, just like a Roth IRA, you know? So, but here's the thing. You're probably sitting there. What do you think the question they're asking, Sam, is?
What happens when I die?
Yeah, well, how do I pay back that loan? They're saying, I'm borrowing all this money out. Don't I have to pay that loan back? And you do, but when you die, the death benefit, which is tax-free, pays back the loan, and whatever's left, your family gets tax-free. So we're combining by structuring the product, and the companies again have built, you know, the new life insurance policies are designed to do this. So they got policies that are designed to accumulate cash and let you borrow it out efficiently and get good growth and basically work like a Roth IRA, but have a death benefit besides. And then, you know, they're designed so when you die, it pays it off. And then, you know, so this is a really interesting way to grow money tax deferred, but really tax-free, because you never really pay tax on the loan because the death benefit does. I got to be careful from a compliance view. If I say tax-free, it's tax-free with brackets around it. Now, the disadvantage is, to make this work, it's got to be in there at least 10 years, maybe 15. So, you know, if you're in your 50s and you're trying to figure out where's my money going to come from when I'm in my 70s, this can be a great place to stick money and grow it. What we also use it for is when people bring us, you know, their children, and they're wondering, where can I stick money? Well, this is better than a Roth IRA because I have no limit to what I can put in. I can get access to the money even though I'm not 59 and a half. Most younger folks also need the death benefit because if they die, their kids and all. So it's kind of, again, in this case, it's more like a Swiss Army knife, which has all the tools in one piece. So this is the ability to use life insurance to grow money. Has to be the right kind of policy, has to be structured right. It's got to be done right. But if so, it can be a powerful, powerful tool. So anyhow, that's another piece. How are we doing for time? Boy, half hours go fast.
They sure do.
Yeah, let
Hey,
me
I do have a pertinent question about the single premium, the one that you showed, the first one, that first example. Pat wants to know, does it need to be from non-IRA funds? Can you use IRA money for this? How does that work?
There's one company that lets you do this with IRA money, and they got a complicated system where they're taking some of that money out every year. You don't get all these advantages like being able to cash it in right away with IRA money, but there is one company that has some applications that works with IRA. For the most part, the one I just described only works with non-IRA money. But there is one, and we've used it for some folks, where you can basically get your IRA to get you more long-term care and some growth and things too. So, okay. I bet you it's time for a wine draw in here. But we may have to do a part 3 sometime. And we have to do one on long-term care. We've never done one on long-term care. We've got to go do a whole.
We were talking about it today because we breezed over the way that life insurance has picked up the slack in the long-term care industry, but essentially there are so many different ways that the life insurance industry has solved for long-term care that it warrants its own half hour.
Changed a lot since these days. So
it has absolutely. All right, so it's time for my favorite part of the week. It is our wine drawing. And for those of you who do not already are not familiar, to get your name in our my jar of names for our wine raffle, all you have to do is throughout the week, you can respond to any of the emails that we send out and reply with either a future topic that you would like to see us cover, a question about the topic that we are going to be covering this week, or you can simply just say, enter me into the wine drawing. You can also RSVP that you're attending to our Facebook event. That's one of the easiest ways. Or if you forward on our emails or, invite somebody else to our happy half hours and let us know about it, we'll give you an additional entry into the wine drawing. Pretty much any way, send us a carrier pigeon, give us a call, any way that you want it, you can let us know. We want to get your name in here and give away wine. So if this is, did we start by giving away wine on the first happy half hour?
We did, yes.
I'm
pretty sure, yes.
Then we are going to be giving away, after today, we will have given away 80 bottles of wine.
80 bottles. Well,
right?
you're making me thirsty. I'm waiting for the Manhattan tonight.
I want some wine.
So our winner of 2 bottles of wine from Fermental Bottle Shop, located in Ogden, a great family-owned bottle shop. We'd love to support them. Head on out there if it's on a beautiful evening like tonight. They have a beautiful patio area, lots of picnic tables, live music, just a really cool outside spot. But our winner of 2 bottles of wine the winners are Barb and Dan B.
Oh, congrats. I was just on the phone with Barb and Dan. They're in the mountains, right? They're in their cabin in the mountains. So
they did, and I believe that they got an extra entry because they did send this to a friend. So congratulations, Barb and Dan. You are our wine winners. So we will be in touch and make sure you get those. And for everybody who did not win and has not won yet, keep entering. Can't wait to pick your name and send you wine.
Sounds good. And it is 5 o'clock. With that, everybody, I want to just a little toast to our 40th happy half hour.
We're over the hill.
It has been fun. Everyone has been fun. We look forward to seeing you next week. Watch the email. We haven't figured out what we're doing yet. Send in any recommendations you got. and we will see you then. Cheers, everybody.
Cheers.